Top three charts for this coming week. Hey folks, that's Serge Berger here, your host of the Steady Wealth Podcast. And of course, when we talk about the top three charts, that is going to be very, very subjective, right? That is just our view. None of this is supposed to be investment advice, but rather just our take on the market. And when we look at the market here these days and we talk about the almost insatiable appetite for risk, it's very difficult not to get some FOMO. And we see this, and I actually just recorded a quick message for our clients, and I talked about how we're seeing a lot of FOMO even from them, and they obviously follow our process of respecting trends but not chasing. And I'll share this with you here as well. I have not, since 17 years is the better way of putting it, have I seen this many people being this bullish and this much not thinking a 5% pullback or more than a 5% pullback in the S&P 500 is possible. And so when I see these numbers, when I look at this historically and statistically, I see that a lot of people are simply not aware of history. And that 5% pullbacks in the S&P 500, not only are they garden variety, in fact, they're barely garden variety, 10% is garden variety, but they're actually healthy. And so to think that we can't get 10% pullbacks in an election year and all the other things that are apparently going so great, no judgment on my part on that part, just on the fact that people don't think we can get more than 5% pullback, to me speaks to just extreme complacency. So I just thought I'd point this out. Now, let's talk about the top three charts. Again, an hour review for this coming week and beyond. This is not meant to be just for this coming week, but for the next few weeks or so is the thinking. I do want to quickly talk about the Fed, though. And one of the things that when we listened to the Fed last week, and Chair Powell was, in my view, was quite dovish. I'm sure some people have different interpretation. In our view, though, what really stuck out is that despite him acknowledging that there is pockets of weakness in the economy, inflation is still a thing, unemployment's very low, all those things, that he still expects 3 rate cuts this year. And so it was against logic. And so to me, the only explanation that he would still be so dovish and talk about these 3 potential rate cuts is because of the national debt, right? I think they are starting to realize that, and I'm sure they've thought about this all along. I don't think the Fed is stupid personally. I think they realize they have to start lowering rates to some extent because they cannot finance the debt, the national debt, at the levels we currently have in terms of interest rates. So to me, that's the only explanation. Other explanations that I've heard is people saying the Fed sees something we don't see, that something's going to break imminently, they're going to cut rates. It's possible. I think that's less likely because typically the Fed tends to be reactionary rather than anticipatory in terms of events like that. So I think this is more about the debt. But anyway, so let's get right to it. I'll be quite quick on this here today. Let's look at 3 charts. And again, if you are listening to this on a traditional podcast channel, do not worry. I'll talk about these charts here in great detail, so you do not need to see them. If you watch it on YouTube, of course, you will see this. So let me quickly talk about these 3. The first one, and I know this is a bit cliche, but it is honestly, I think, extremely important. Let's talk about the S&P 500. I think the S&P 500 is at an incredibly important juncture. And again, keeping in mind what I consider to be complacency on the part of many investors, particularly retail investors, I want to just put this into some context. So first of all, the S&P 500 in about January, let's call it mid-January this year, essentially broke to a fresh all-time high. And when it did that, it didn't pause, it actually accelerated. To me, when you see an acceleration upon a breakout like that without any check back, it speaks to inflows and chasing and momentum and exuberance. Obviously, people who've done that have done very well. So this is actually to their credit, I'm saying this. What's happening now, though, is we're getting some extremities of duration. For example, one simple statistic that I've come across a couple times now. We haven't had a 2% pullback in something like 2 years, a 2% one-day pullback in the S&P. But also, and to me, this is really more the point, this is really what I'm looking for. And I think I've mentioned this before in these podcasts. If not, I certainly talked about it to clients every week. The S&P 500 algorithms are extremely tuned in on one simple moving average right now. That'll change over time, but right now it's the 21 period moving average. If you can see the screen right now, you'll see there's a yellow line that is basically been star support, almost eerily, spookily good support since basically we broke above that moving average in early November of 2023. So the algorithms continue to buy there almost with no questions asked. Last week, they bought again right at that moving average after Chair Powell, or actually before, the day before even. So that's the moving average. That's the line in the sand. To me, that is why this is such an important line in the sand. Most Americans' portfolios are basically tracking the S&P 500 in some shape or form. If it's not a 90% correlation, it's a 70% correlation. I think that's why this is such an important chart. The line in the sand right now, the 21 period moving average, where it is right now, and obviously it changes every day, so do check this out yourself, but it's about 5,135-ish is about where it is right now as I'm recording this here on Sunday, the 24th of March. So watch that. Obviously, it's rising, so that level continues to go up. Just so you know, as of right now, if we were to have a 2% down day in any given day, we would break below that moving average in one day. That's how close this moving average is. So that's just a bit of an FYI. So I think this is an incredibly important index to watch, an important level to watch, which, and again, I say it, I think it's maybe a bit cliche talking about the S&P as the top chart, but it really is right now because there's so much momentum and the momentum players, and it takes very little at this point for us to break that 21 period moving average. But of course, until we break it, we haven't broken it, right? So it remains a trend followers game. That's chart number one. And I have two more, and I'll give you two bonus ones as well. The second one, again, this may also be somewhat cliche, but this is the Russell 2000. And I'm going to look at the Russell 2000 here through the lens of the IWM ETF. What we are seeing over the past number of weeks is we have seen a broadening out of the rally of the market. And it's not just in equities. We've seen some pockets of broadening in the equity market for sure, but it's also in other parts of the market. And we'll talk about inflation secure things that go up as inflation goes up, like energy. And I've got a tremendous chart that one of our analysts, JB, created for us a few days ago. So I'll show this to you as well. We'll talk about it. But I think the Russell 2000 is important, the IWM, because if we're going to see a further broadening at some point, and I don't know when that is, but at some point, the Russell 2000 or the IWM ETF that tracks the Russell 2000 is going to likely break above, let's say, $208. And then when that happens, I think this will be a decent trade. I don't think the Russell 2000 is going to make fresh all-time highs. That at these levels where we are right now, again, as I'm recording this right now, would be about as 18% higher. I don't think we break above there. I don't think we're in that cycle. I think we're late cycle, not early cycle. But we can still see a breakout and maybe a double top or something. That's entirely possible. So the Russell 2000, again, somewhat cliche. That's an important chart, I think, right now. Why? Because I actually think if you want to look at this through the lens of a pairs trade, I wouldn't be surprised. In fact, it's a little bit my base case that we see the S&P 500 start to cool off here over the next weeks, maybe a few months, and maybe the Russell 2000 catch up and actually start becoming a relative outperformer. So obviously we'll see if that actually plays out, but that is how I see it, and that is again why these two charts are on top of my mind right now. Another one, and I hate to say it, but this one too might be somewhat cliche, but it is that important right now, is the 10-year yield. I've mentioned it tirelessly almost every day now for in the latest round here for the past couple of weeks. But I think the risk for the equity market, and there could be many risks, but one of the risks is if the 10-year goes back above 435, 440. That's 4.35, 4.4% on the US 10-year Treasury note. Last week, what happened after the Fed's dovishness, to be expected, is the 10-year actually dropped from about 435 to close the week around 420. So that's a 15 basis point swing. For those people who don't follow the bond market, that's not a small move. That's, I think, the other chart. Keep watching the 10-year. If yields go meaningfully lower from here, who knows? At some point, the equity market won't find that so cool. If it stays above 380 or so, the equity market may just like it more. I don't know. I just think I'm more focusing on the upside. If we break about 435, 440, that to me would be something worth watching as a risk factor. Let's look at another chart. And this one here is an early signals. And I'm going to quickly craft this one here. Again, if you're not watching this on YouTube, do not worry. I'm just going to quickly create a chart and show you or talk about how the S&P 500, the Bitcoin has historically actually been a leading indicator for risk assets. So what I'm showing here, and again, if you can't see the chart, do not worry, it doesn't matter one bit. What we have seen for the past 10 days or so is Bitcoin, and this could change, but we've seen it for the past 10 days or so, is Bitcoin has actually been underperforming since it made all new all-time highs. It broke above 70,000, pulled back. It's been pulling back, and it's not falling apart, obviously by no means, and I still think it's a bull market, but we've seen risk coming out of Bitcoin. Historically speaking, the longer this continues, so the better a signal this is a leading indicator to equities, to like the NASDAQ 100, which is what the other chart is here I'm looking at. If you can't see the chart, what I'm doing, I'm pinning Bitcoin versus, or comparing him versus the NASDAQ 100. And the NASDAQ 100 last week, of course, made fresh all-time highs again, thanks to a dovish Fed. Bitcoin did not. Bitcoin actually is making marginal, and again, baby steps are lower highs. So in the near term, again, I still think it's going to go higher. So watch Bitcoin. It has become a really good measurement of risk. So the more Bitcoin has marginal selling pressure, the more the risk assets are something we want to keep an eye on. That's the first bonus chart. The second bonus chart I have for you, again, this was crafted by one of my analysts, JB, John Burnell. And what this point here is, we've seen obviously inflation become a bit stickier. Again, last week didn't matter because Powell was so dovish. But we've seen interest rates at the margin over a number of weeks now start to creep back higher. Equally, energy stocks have been going higher. In relative terms, we've seen energy stocks versus the S&P 500, even equally weighted energy stocks. There's all sorts of ways of slicing this. I don't want to make it too complex, but we've seen essentially risk assets behave in such risk assets that are inflation protecting, meaning if we buy energy stocks and others, we've seen those kinds of assets continue to move higher. And I'll show you actually another way of looking at this. This is, again, our analyst, John Burnell, made another chart. I'm trying to find it. I may not be able to show it to you. Anyway, it doesn't matter. The point really here more is that that we've seen risk assets essentially trade higher, but we're also seeing a broadening of the rally, and that's where we come full circle. We've seen a broadening of the rally that has now included also energy stocks. These are some of these inflation stories. So people are buying energy stocks, people are buying in part maybe treasuries, but also other things like gold, because those things can benefit when inflation is a thing. And inflation has become a thing once again. So that's why these things are going higher. Energy stocks, as I'm looking at this right now, energy stocks are within a whisper of breaking to all-time highs. So our long-term bullish energy thesis there continues to manifest itself. So those are the top three charts I'm looking at here for the new trading week ahead. It is a holiday shortened trading week. We have Easter Friday, or Good Friday as it's called, is a holiday for U.S. markets, a holiday for most, certainly European markets as well. And then the following week will be slower as well to get started. We have some markets are going to be closed because of Easter Monday. But those are the top three charts, including the two bonus charts, Bitcoin versus the NASDAQ. Again, leading indicator there, Bitcoin. And again, our inflation charts there. Hope it was helpful, folks. Thanks for listening. Any questions, comments, please let us know. Have a great start to the week. And we'll see you again back here in the next Steady Wealth podcast episode. Until then, be well.